There's a good reason to be seriously worried, and I'm actually surprised that not more people talk about this. Most people just look at Bitcoin's history. They try to figure out how are the cycles going, but the problem is during the entire lifetime of Bitcoin's history, in general, the financial market has been very, very healthy. Because here's the truth, Bitcoin and crypto as an extension is still traded as a risk-on asset, as in when traditional finance is coming down, when stocks are crashing, then that takes Bitcoin and cryptos as a whole with it. And so most people just look at charts like this. So this is Bitcoin over the very long term on a logarithmic scale. The chart starts in 2010. And it implies that Bitcoin is very unlikely to ever fall below this white support line, which by the way currently is at around 50k or so. Or then there's mathematical models like this, right? The market value to realized value z-score. We should always buy whenever the current price is below the realized price. There's all kinds of models. But the problem and the inherent limitation of such models is that they only look at the Bitcoin price since it started trading. But again, Bitcoin never has seen a real crisis. What we see here is the S&P 500. And the vertical line here, this is when Bitcoin launched. It was at the height of the GFC, of the global financial crisis, when all the banks got bailed out. This is where Bitcoin was invented. The very first Genesis block talks about this. The very first Genesis block had an inscription of a New York Times article in it, where there was a bank bailout in Germany. So we had the dot-com crisis, we had the global financial crisis, and the COVID crash over here is just a little bit of a blip that very quickly recovered again. We really never saw a proper correction during Bitcoin's lifetime, where stocks fell by more than 50%. We never had this. We can see this even clearer once we compare stock prices relative to the US money supply, because the majority of the appreciation of any asset class is just the devaluation of the dollar. It's more and more dollars getting issued over time. USM2, so the US money supply, tends to grow by 6.8% per annum. The official inflation rate during that time was only 3.3%, but really the monetary base expanded by 6.8%. We've got a hidden delta of 3.5% every single year. So when we divide the S&P 500 by the money supply, and now we look at when did Bitcoin get invented, we really only saw stocks outperforming monetary expansion since then. So again, this is the dot-com crisis and this is the global financial crisis. Bitcoin never really saw any real kind of crisis. And this is concerning because of two reasons. First of all our models that we use for Bitcoin's price data, they might break during times of real crisis. But secondly, if Bitcoin was to crash much more than it ever did in the past, if it suddenly goes to $10,000 for example, how much would this actually destroy long-term holder confidence? Maybe at that point, Bitcoin has a hard time ever recovering. Here's another way to look at the same thing. This is the Shiller PE ratio. So this looks at the S&P 500's market cap relative to the earnings. This is a very long-term chart. It starts in 1871. So this is 150 years of data. And we are at an historical high again. And this year, that's when Bitcoin got launched. In the year 2009. Now Bitcoin and stocks are not the same thing, but again, there is correlation between the two asset classes. Maybe you haven't been active in the crypto space at the time, but have a look at Bitcoin's price, that's in green, and have a look at the S&P 500, that's in red. We can clearly see how Bitcoin was not a safe haven asset when the S&P 500 crashed during COVID. Rather the opposite, Bitcoin crashed even more during that crisis by 63%. And so I very much believe in case we do see another crisis that's comparable to the GFC, that's comparable to the dot-com crisis, maybe an AI bubble burst, maybe something else, maybe a banking crisis, who knows what will be the trigger. But in case we do see another deleveraging of global financial markets, Bitcoin and crypto as an extension is going to crash even more. I think this is very, very likely. Now in the last years, and especially the last months, I talked about buying gold instead of stocks as a hedge, so that in case crypto goes down, we've got at least something that's risk off, that's something that's comparatively cheap. And yes, the S&P 500, so the stock market relative to gold, is historically very expensive. This chart starts in 1884. And so maybe it makes sense to buy gold versus the S&P 500. Maybe there's upside potential of more than 600%. The average price of gold relative to the S&P 500, that's a dotted line over here, indicates that gold is still a comparatively good bet relative to stocks, right? Gold could outperform by more than 180%. So this still seems to make sense. The problem is that capital over time concentrates further and further. And so the prices of investment relative to what they can return tend to appreciate more and more. Now, gold doesn't return anything directly in terms of cash flow, but it does return in terms of an insurance, as in case things go really, really south, we've got something that keeps value to a degree. But here's the problem. That insurance is becoming more and more expensive as well. So this is gold relative to the US money supply. And again, the dotted line shows the average price. And again, this is a long-term chart. It starts in 1959. Currently, the gold price is roughly 44% above its historical average. So gold isn't that cheap in the grand scheme of things either. It's also expensive. It's not as expensive as stocks. It's still the better bet compared to buying the S&P 500, in my humble opinion. But is it really that great of a buy when it's so expensive relative to the money supply? If we look at the current price, historically, over the last 65 years, we haven't been above it for a prolonged period of time. Only at the hype cycle at the end of the 70s, gold was much higher. But beyond that, we barely had been higher relative to the money supply. We could try going further down the rabbit hole, look at other precious metals, but the picture isn't much better. This is silver relative to the money supply, and yes, it's below the historical average, and yes, there's maybe a little bit more upside, but that's around 30% from here. Silver has also appreciated quite a bit in the last years. Here is palladium relative to its historical average. It also looks like there's some upside, maybe 25%, but is it really worth it given that palladium is mainly just used as an automotive catalyst? 70 to 80% of the global demand comes from the car manufacturing business. And if we actually go through a real crisis, will palladium, and if we're really about to go through a real global depression, are we going to see that much demand in the car market? I doubt it, right? Usually cars are very pro-cyclical. And so this video is mainly about showing the problem. The issue really is that our current models of Bitcoin's volatility might underappreciate how risky the asset really is. Because Bitcoin still moves as a risk-on asset. It still sells off during times of crisis. And historically, we are extremely high in the stock market, both in terms of its PE ratio, but also in terms of its ratio to the money supply and its ratio to gold. And the problem is that even gold is starting to become expensive. And so I don't have a good answer to this. Now, I'm starting to reduce my exposure to the gold price. I'm selling gold ETF. Now, I still hold physical gold. I have that physical gold as an insurance in case we see a real complete explosion of the system. The reason why I've got the gold in physical form is because we don't really know what happens to those ETFs when something really is going down. But owning a lot of gold as a heavy weight in the portfolio probably isn't that great either anymore. It was justified to own a lot of gold 2 or 3 years ago, when the price was still heavily below the historical average. But now, really, any gold purchase is a speculation that the system will completely blow up or that we get massive hype around gold. Now, I know it's not very sexy, but I'm personally allocating more and more towards cash or towards fixed deposits. Now, fixed deposits cannot make up for the entire monetary debasement. Currently, the target interest rate is slightly above 4%. And again, the monetary debasement long term is 6.8%. So we are losing 2.8% purchasing power every single year. But maybe that's the worst of all evils, when stocks are historically that expensive and when gold as a risk-off diversifier also becomes less and less attractive over time. Now, isn't it fascinating how the asset selection itself seems to be rather a secondary problem, as in there are market phases where everything is going down at the same time. And then there are other market phases where most altcoins tend to go up. There's just so much correlation within crypto. What we see in green, that's the market cap of the altcoins that are not in the top 10. What we see in orange is the market cap of Bitcoin. What we see in blue is the market cap of Ethereum. So this is just relative performances over time. They all go up and go down at the same time. Now what's important to note here though, that this is a comparison of market caps. It's not a comparison of prices, because actually the small altcoins tend to perform much worse than the market cap implies. This here is the performance of the smaller altcoins, so from rank 800 to 900 in the last year. There are a few outperformers. So there's 1, 2, 3, maybe 4 altcoins that did roughly 100% and a bit more. Now, why am I talking about the 100% cutoff? Because that's how much Bitcoin made in the last year. So that should be our benchmark. All the altcoins that did not return 100% in the last year did much worse. And that's obviously the vast majority. We are seeing here 100 alts and only 4 did better than BTC. So really, trading altcoins is incredibly risky. Now, why do the altcoins perform that poorly? It's because of tokenomics, or in other words, the supply of many altcoins grows very quickly, much faster than the demand, which then depresses the price. There's all kinds of different flavors of token inflation. There's the constant inflation, like over here for ApeCoin. There is the cliff unlocks, as over here with 1inch. Or there's a mixture of both. We've got constant expansion plus cliff unlocks. That's now here as an example, XE Infinity. And so because of that increasing supply, just holding a broad basket of altcoins is a very bad idea. This is a good idea in the stock market. It's not so good of an idea in crypto. Have a look at what happens with most altcoins. This is ApeCoin over time. This is 1inch over time. And here is XE Infinity over time. When the supply grows constantly, the price tends to go down because the demand has a very hard time catching up. And so I personally generate my alpha, my outperformance over buying and holding Bitcoin with exactly that strategy. I still like to hold Bitcoin, but at the same time, I'm also betting on falling prices of especially the weaker altcoins that expand quickly in supply. I made many videos on the topic, but actually you don't have to watch all of this. Just have a look at what kind of outperformance can be achieved. What we see here in orange, that's Bitcoin. And what we see in green, that's going long Bitcoin and short ApeCoin at the same time. So we're betting on falling prices of ApeCoin. At the same time, we're betting on rising prices of Bitcoin. And then we get this nice performance, which is way steeper compared to what just buying and holding Bitcoin provides. Here's Bitcoin versus 1inch. So again, massive outperformance, 4,400%, while just buying and holding Bitcoin during the same time period returned less than 400%. And over here, we've got Bitcoin relative to XE Infinity. Now, this is just a few examples. I'm actually following this strategy already for the last 4 years. And had I just dollar cost averaged into Bitcoin, I would have gotten this performance here in light gray. But because I also bet on falling prices of highly inflationary altcoins, I got the performance here in black. Now, very often, the first reaction that I get when I describe this strategy is that this is too complicated. Just tell us the next big altcoin that makes a 10 or 100x and everything is fine. But I don't think it is. Because again, just have a look at these smaller altcoins in the last year. There is a 90+% likelihood that you're going to do worse than Bitcoin. And even if you pick an altcoin that's doing better, once you diversify a little bit, the portfolio is likely going to go down. Again, because the insiders constantly cash out and dump on the average retail investor. This is an unpopular story within crypto because it doesn't sell as well, right? Most influencers, they actually get paid by the crypto project in order to promote the project. And so they just say this is the next 10 or the next 100x altcoin. And then of course the insiders, they dump on retail, the altcoin actually crashes and does not do the 10 or 100x. And so I just like constant outperformance over trying to find the one lottery ticket. Now, in the end, it's actually not that complicated to set up those relative valuation trades. There are only 2 videos that you have to watch. Here's the first video using using perpetual futures on Hyperliquid. And here is the second video, risk management with relative valuation bets. Once you've watched those two videos, which is in total 1 hour of content, then you know exactly what to do in order to get this performance or this performance or this performance. After you've watched those two videos, I will share my favorite trade with you. And those favorite trades have still a lot of token inflation ahead. The 3 examples that we looked at, they have already inflated. Most of the supply is already circulating. But my favorite trade still has a lot of token dilution in front of it. So it's likely going to continue to underperform. I'm so confident in that particular trade that in case you do not make money with that trade after holding it for 1 month, then I will refund the premium membership fee to you. So you don't pay anything for premium if that trade doesn't make you money. So the whole idea is that premium pays for itself. You sign up, you watch 2 videos, you open the favorite trade, and again, if you don't make money with that trade, you will get the $125 back, no questions asked. A link to premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.